Welcome back to the podcast. I'm Barry Schwartz. I'm joined, as usual, with Ernest Wong. Good to see you today, Ernest.
Good to see you.
Thankfully, we are nice and warm and we don't have to do any shoveling because it's finally started to snow in Toronto. So winter has finally started a few weeks late, though.
You mean you do have to do shoveling?
Well, not today. I'm stuck in here and I can avoid it. Someone else can do it for me. So, Ernest, we have a lot of new clients and over the last year or so, and this podcast has grown. So we wanted to do a little bit of introduction about our roles at the firm, what a chief investment officer does. That's my role. What a head of research guy does. That's your role. Talk a little bit about investment strategy, the types of companies we like to buy, and what you do all day. And so I think people will find that helpful and maybe learn more about our style and our philosophy. Sound good?
Ready to go.
All right, let's get into it. So I'm the Chief Investment Officer at Baskin Wealth. I've been at Baskin for, I can't believe it, 24 years, Ernest. Started working with my partner, David Baskin, in the summer of 2000, which, if you look at my face, the math doesn't make any sense because how can I be working at somewhere 24 years old and so young and good looking? But that's time flies. That's what's happened. So hopefully knowledge is compounded. So as Chief Investment Officer, I work closely with you and the trading team to determine the portfolio construction, to determine the types of companies that go into it. We work together to try and figure out what the best companies that go into it. You and I are, I would say, obsessed with investing.
I would say so.
Yeah. So for those that don't know me and Ernest, we're probably talking online on Teams about stocks most of the day, most of the night, weekends. It's just something we enjoy and we like to do, and we share that passion together. Hopefully that makes us better investors. And as Chief Investment Officer, Ernest and I work closely together. Ernest does a lot of the research on the companies. Mostly he will come up with ideas. Sometimes I will push him for the ideas I want to see. But we have an idea of the types of names we want to look at, the types of companies that we feel is appropriate. And I think in a future podcast, we'll talk about portfolio construction, but really I want Ernest, you to talk about your role as head of his research. And I think a lot of people will find it fascinating what you do all day and how you look for stocks and how you convince me and the rest of the portfolio management team why the stocks that we're picking are the right fits for our clients.
Right. So my role is head of research for Baskin Wealth Management. And my primary responsibility here is to conduct the research and decide which companies go into our portfolio. And I would say, equally importantly, ensure that we are up to date on the names that we already own.
That's the most important, following the companies we already own. But go ahead. Yep.
So maybe just to have a little bit of background on what types of companies that we are looking to own.
Yeah, and maybe even before that, talk about how we manage money. Like, are we a hedge fund? Are we a mutual fund? What are we trying to achieve for our clients?
I think that's one of the more, not misunderstood, but maybe underappreciated aspects of our business is that we are a wealth management firm. Mm-hmm. We manage typically most of the wealth of the clients that we are managing money for.
That's a great point. And even if we aren't, the way we approach it is we feel like we're going to be managing all your money. And so whether you tell us you want us only to buy you bonds or Canadian stocks or just only stocks only, we still take the approach that we're buying and we're spending all and investing all of your investable wealth, and think about it in that way.
And I think this is an important distinction to make because there's a lot of different types of investment structures out there, like such as hedge funds, mutual funds, venture capital funds,
alternative asset managers. Mm-hmm.
And each of these have their own investment objectives. For us, because we're a wealth firm and managing all the money of our clients, usually, we want to protect the wealth.
100%. As we all know from psychological behavior in terms of investing, people feel the pain more on the downside than they do on the upside. So you want to protect that downside.
And so our investment strategy has really been designed to reflect this objective. We want to look for companies that match this profile of our clients, like companies that can be counted on to grow wealth consistently over time with ideally less downside. And I think this sounds obvious, but it's really not, because there's a lot of different stocks out there that simply don't do this, right? There are companies that are more lottery ticket in their nature. For example, if you're investing in like a company that's trying to discover a new drug for cancer, for example, like most of the time that company is probably not going to work out very well. But if they discover the cure for cancer, you're going to make a lot of money.
Yeah. Well, if I go to a convenience store and I keep playing the lottery, maybe one day I'll win. But chances are I'm going to lose all my money over the long term.
And that's exactly what we don't want to look for.
Nope.
What we do want to look for is companies that already make a lot of money and that we can count on to deliver, to continue to make money and find ways to invest it intelligently going forward.
Yeah. I mean, what we're trying to do is partner with the management of well-run businesses. Hopefully they've shown some business acumen, great capital allocation skills, created a strong culture, whatever that paradigm is, and proven to do well in a lot of different environments, or so we think, and attach ourselves to that. And us thinking long-term, the businesses that we own that think long-term, hopefully that's a nice marriage.
And our thesis is that if you own a basket of these types of companies, you're going to do pretty well over time.
Yeah.
Right. You might not hit on the spectacular winners in 1 year.
Nope.
Right. The company that discovers gold in Panama.
Yeah.
But over time, these companies will continue to make money, and they have proven to do so.
Yeah. Perfect example is we're going to miss Elon Musk and Tesla at the beginning stages. It's not proven. Who knows if EVs are going to win? The company is, has a lot of debt at the beginning. It's not making any money. We're not attracted to those situations, so we're going to miss the gigantic upside. But for every Tesla that works out, there's 99 other companies that you lose all your money in.
And I think beyond the lottery tickets, there's another category of company that we don't typically invest in, which is that I think there's a lot of investors out there that look for what I would call short-term valuation pops, right? A company that maybe appears undervalued, maybe the stock has fallen significantly in the near term, but they're looking for a catalyst why the stock might jump 20% on a good earnings report, right?
Right. So an example, maybe like Dollar General, right? Its earnings results kept missing expectations, worries about theft at the stores. I mean, eventually the next quarter and the next quarter won't be as bad as the first horrible shock. And then the stock may pop back to a certain level, but it's still maybe not a good business, not well run. Why are we going to take chances on owning a bad business that may be in decline?
And that's exactly what we are not looking for.
Correct.
So what are we looking for, right? I think we are looking for, as I said earlier, we're looking for good businesses that are run by intelligent CEOs and management teams. And I think that, I kind of realized that everybody in our industry says the same thing.
Well, if you're a long-term investor and you want to be in this business for the foreseeable future, you can't be buying crappy companies or silly stuff or speculative stuff. It just doesn't work. So that's the right approach for the long-term mindset.
And I also realized that buying good businesses at attractive valuations has become kind of meaningless in our industry. My old boss at my former employer, he always likes to say, nobody ever intentionally overpays for terrible businesses.
Of course not.
Right?
Yeah.
But I like to think that we really do care more about the quality of our businesses than the average investor does, right?
Yeah. So I mean, I agree with that. That's exactly what we're looking for. And sometimes, Ernest, the businesses that we own have some kind of amazing natural competitive advantage that makes the business so good that it's hard to compete with. I mean, a perfect example is all the big techs. They've overwhelmed everything else. They've been allowed to grow to sizes that are so big. They're generating so much cash flow that it's hard to see them losing that steam in the short term. You can argue whether the CEOs are the best intelligent allocators of capital, but the businesses themselves are just so good. As Warren Buffett says, sometimes it's okay to own a business where the CEO is a ham sandwich, as long as that business is really good. I hope we don't own any businesses where the CEO is a ham sandwich.
No,
Yeah.
no, I don't think we do.
Yeah.
I think that, and maybe as a side observation, I actually don't think that there are too many investors, certainly in Canada, that we look at that really invest the way that we do. Right? There are a lot of investors who invest in good companies, but I typically find that they are more focused on near-term valuation metrics. Right? They're looking for companies that maybe have a lower price to earnings ratio.
Yeah.
They're looking for companies that maybe pay a high dividend. Right?
Not that there's anything wrong with dividends. It could be the right allocation of capital for that company. It's just we don't want to narrow ourselves to one strategy, to one style, especially when we think we understand where compounding comes from. And you and I have had this conversation. I really think a lot of investors, even some professionals, don't understand the power of compounding. Compounding in your portfolio, compounding your returns from stocks comes from reinvestment of cash flows in the business, not being paid to you as dividends. There's no compounding that happens there. The compounding happens when you let Warren Buffett at Berkshire or Mark Leonard at Constellation or Bruce Flatt at Brookfield reinvest the cash flows instead of paying it to you to grow the business. And if you pick a few of those names, you're going to do, I think, quite well.
And I think this is the factor, the compounding aspect, that is typically more underpriced in the stock market. Everybody can do a screen and search for companies that trade at 15 times price PE or less.
Absolutely.
Right?
Yeah.
And there's a whole industry of research analysts, like sell-side analysts at banks.
Mm-hmm.
I think they do a pretty good job at discussing the near-term risks and growth opportunities that companies have. But I think when you have a terrific CEO who is able to compound the cash flows properly, I think the market seems to not be able to price this adequately. And these companies historically do tend to do very well.
Yeah. So you're exchanging near-term certainty of cash flows with names like Bell Canada and TELUS and pipelines and banks, and where the dividends are more certain, to the uncertainty of the long-term duration of how that manager allocates the cash flows. But like we said, the returns can be spectacular. And the truth of the matter is, in my experience, you don't need to pick 35 stocks. You're never going to get 35 stocks in your portfolio that all are terrific compounders. But if you have a handful of them and you're patient with them, you can really outperform.
And I think the aspect that is probably the most important that I focus on is the quality of the management team, right? Certainly, there are great businesses where, like as Warren Buffett says, an idiot can run it, right? Like Coca-Cola probably being the most famous example of that.
Not that we're calling the CEO of Coca-Cola an idiot, but yeah, it's a pretty good business that generally can run itself, although anyways.
But if you have an outstanding CEO, they always find ways to surprise you on the upside.
Okay, so why don't you talk about how does one determine the quality of management? It's hard. It's not a quantitative formula that you can come up with to find the best managers of publicly traded companies.
A lot of that is really from studying the track record of the company. You can tell if somebody is running the business well or not, right? Like just like you can tell if there's a good basketball player.
Yeah.
It's pretty obvious if you study it.
I think that's a very good comment. Yeah.
And conversely, it's pretty easy to tell when a business is not running well, right? You can see it in maybe the employees are complaining, like maybe there's like the stores are dirty,
Yeah.
the margins, they don't make a lot of money, like there's always some issue popping up with the business. Like these are all signs that the business is not running well. Conversely, great businesses always find ways to surprise you on the upside, right? So I think probably the easiest example of that is Apple. An investor in Apple in 2010, right? They would never have imagined all of the products that they have launched since then.
Never.
Right.
Never. And a few years later, they would have said the company's not innovating anymore, where they're just going to keep coming out with iPhone 6, 7, 8, 9, 10. And, it's going to go the way of BlackBerry or Research in Motion.
And there's no fundamental analysis, like the numbers and numbers work you could have done that would have told you that Apple is what it is today.
No, you never would have figured out that they come up with services, AirPods, watches, you name it. And just as today people are saying Apple's expensive, the growth is slowed, they can't envision what is going to come. So it's all about capital allocation, as you point out. I read the other day that Apple has like 20,000 patents. They're working on a lot of stuff. They're spending billions on R&D, and so far they've proven that they're pretty good at it.
Exactly. And that's what we're trying to look for across our portfolio.
That's a good summary. Okay.
I think one other thing that I would say is that if you have a really good capital allocator, they always find ways to create value for the business. There are a lot of...
How is that different than surprising you?
Yes. Yeah. So let me give you an example.
Okay.
CoStar Group is a company that we've owned and talked about before.
And we did a podcast. Yeah, we did a podcast on it. Correct. Yeah.
When the share price is expensive, right? I think there was unanimous consensus that the stock price was overvalued in the near term. The CEO went out and he did a big share offering. Like he issued stock because he was getting a good deal for selling stock and raising capital that he can use for the future. When the share price is cheap, like as it was maybe a few years ago, he went out and bought back stock, right? So he's always looking for ways to create value, kind of regardless of what the market is pricing his company at. And if you compare that to maybe some of the tech companies that unprofitable tech companies that existed in 2021, all they're trying to do today is survive.
They should have. So what you're saying is a lot of those tech companies in 2021 should have been issuing shares hand over fist, taking advantage of the stupid valuations that we all paid for companies in 2021, and padded themselves in case of a bad downturn or the market going down or what recession or what have you. And that's exactly what happened a year later in 2022. And yeah,
right. And that was pretty. I think that's true across the board for our portfolio.
Yeah,
because these tend to be large businesses. They tend to have very strong balance sheets. Tend to be run by very good CEOs, and I think that reflected itself especially in 2022 when, even though the share prices of these companies did not necessarily perform the best, they were still able to gain market share and remain solidly profitable.
Okay. So what other things do you look for when you're coming up with ideas to fit into the Baskin portfolio? Obviously, I know the answer, but we're sharing it with everybody here.
I think one underrated factor is the alignment of management and major shareholders to us as minority passive owners of a company.
Skin in the game.
Right.
Okay.
And I think this has become very apparent for many companies on the TSX.
Okay.
Smaller companies where they went public in kind of lofty valuations in 2021.
Well, you tend to go public when times are good, right? And just take advantage of the window, that opening when people are more bullish about the outlook for the economy or the market. So generally, you tend to get good valuations when you IPO in a good time.
Good valuations for the seller.
Yeah, for the seller.
Yes.
Exactly. Okay.
So the CEO cashed out, sold expensive stock mostly to retail investors. They sold them in 2021. Stock price collapses.
We're not going to name names, but there's about 4 or 5 of these companies that happened in 2021 at least.
The stock price collapses.
Okay.
Stock is obviously cheap, right? These are fine businesses that deserve to exist and trade at pretty attractive valuations.
And maybe the stock price has fallen so much that managers that are buying large or mid-cap stocks can no longer buy a small cap company. It doesn't fit their mutual fund or ETF mandate. And so it becomes like an orphaned stock.
What happens is that you can do the analysis and you would conclude that these were attractively valued stocks and you buy them for your portfolio. But then what happens is that the CEO and maybe a big shareholder come out and they take the company private at a cheap price, right?
So do the IPO at $20, cash out a good chunk of your holdings, stock falls to $2 or $3, offer to take it back, to buy it back from the public at $4. Sounds like a good deal to me. Yeah.
It's a great deal for the management.
Yeah.
They get all the upside as the cycle improves. But as a shareholder, you got hosed. You didn't make a penny.
It's hard to imagine Warren Buffett or Mark Leonard or Jeff Bezos doing those tactics.
And that's just one example.
Yeah.
Like there's infinite numbers of examples of companies that are otherwise good businesses.
Not that there's anything illegal with that, Ernest. It's just, as you're saying, the alignment of management with minority. We are minority shareholders, right? We own a stake in the company, but we have no say about how the business is run, or no voting control whether we are going to approve a takeover or a share buyback. Nothing.
And there's a lot of companies where I think there is clearly no pay for performance.
Yeah.
The CEO is going to make a lot of money regardless of whether the company's doing well or doing terrible.
Yeah.
And we don't want to own that.
No, we do like pay for performance, though. Sometimes it makes sense.
We want to own businesses where the stock does well, we'll make money.
Yeah.
The stock does poorly, we'll lose money, and the management loses money because they own a lot of stock, right? And I think that's a pretty common theme across our portfolio, is that there is often material share ownership by the management team and the board, so that whatever happens to us happens to them as well.
Yeah. So you've talked about valuation a little bit. You've talked about how the market can price stocks maybe too expensive, but underprice the capital allocation. So that's why, if Apple may be expensive, but it can keep doing well because management can add value by surprising and creating value on the upside. And you'll be saying, well, I wish I bought Apple at $184. I thought it was too expensive, and now it's $220. What was I thinking?
That seems to be a common theme for the types of names that we look at. It's that whenever we buy the stock, it's usually not trading at like 10 times earnings.
No, we're looking at a new name right now, Ernest, to add to the portfolio. That's at a 52-week high.
Yes.
And we've missed a gigantic run on it. You can't look at it. You can't think that way. And we can't wait for it to fall to a 52-week low. You can talk about, like, what are we looking for? What metrics are we looking for that makes something attractive even if we're buying an all-time high?
Right. I think that's a good question, because oftentimes I think oftentimes people will ask, well, aren't you simply advocating for paying whatever price?
Yeah.
And how do you make sure that you're not overpaying for the stocks that you own? I think that a lot of the companies that we've owned them for a long time, and they've done spectacularly, right? So there is often a big capital gain, that consequence as a result of selling these companies.
Yeah. So if we're managing money for a client in a taxable account, and some clients have owned Apple for 10 years, Microsoft for 10 years, you can imagine that they've done quite well on it, and selling a portion of it is painful for taxes.
And more importantly is that these are still good companies. Like we expect them to continue to deploy capital intelligently and grow over time, like all the things that we just talked about. So there's no reason to sell, even though the stock price itself has gone up. What we do is, if we find a company that is higher quality, like faster growing, run by a better management team, and is available at a more attractive valuation than the companies that we already own, then we would seriously think about adding it to the portfolio.
That's right. And so our style is we're patient, and hopefully we're getting better at that. My mistakes, if I can list the big mistakes that I've made in the past, not speaking for you, but speaking for me and our clients, is selling too soon. Or the other one, of course, is not saying, I'm going to wait for a pullback because it's gone up so much in a recent period of time. I think those are terrible mistakes investors make.
And I think if you look at our track record over time, like we actually do very little trading because the companies we own are that good. I think we have about 30 names in our portfolio. Might swap like one a year.
So I know we're patting ourselves on the back right now, but 2022, we thought we owned great companies, and a lot of them went down a lot. So you also have to have the foresight. If the thesis doesn't change, not every year, just because you own a good business, is it going to work out? Yeah. So any other factors you want to talk about that we look at when we buy stock? Balance sheet for one. Did we talk about that?
I think that's more of a byproduct of management. There are companies that, like, there are a lot of investors who like leverage, understandably so, because leverage gives you upside.
Of course. Charlie Munger, right before he passed away, gave an interview, and someone said, "What is your biggest regret?" And he's like, "I should have used leverage. I should have been more aggressive at Berkshire Hathaway using leverage, personally, to buy the stock, as well as at Berkshire to make more deals." And that probably would have worked out really great. But can you survive through the crappy times, the recessions, the nasty pullbacks with all that debt? It does change your mindset for sure. It makes you very scared.
And I understand the logic about the investors who like leverage, but I simply prefer companies that have very clean balance sheets, like companies that have very minimal leverage. Maybe they'll use it occasionally if the right opportunity presents itself, but they often run at a net cash position.
And some of the leverage businesses that we own, like a Domino's Pizza or Restaurant Brands, their business models are so highly cash flow generative. Something I read the other day, Ernest, we talked about is Restaurant Brands, for example, that the owner of Popeyes and Burger King and Tim Hortons, it hedged a lot of its debt, the interest rate payments in 2022. It has a leveraged business, but the interest payments that it's paying today haven't gone up because management smartly took advantage of the low interest rates to lock in the spread on the interest rates. And so that's why the business can continue to buy back stock and raise dividends, even though interest rates have gone up.
I think that companies that have clean balance sheets, it's the way that the balance sheet is managed is a really good indication of the alignment of management to the business, right? If you look at one of the things that I often look at is the way management is paid. Right?
Okay.
Often, what kind of criteria they need to hit to earn their bonuses, right? I can tell you, it's very tempting for a CEO to use leverage to increase earnings in the near term because it helps their bonus.
Yeah.
Often, like a lot of times, the bonuses are tied to earnings per share growth, for example.
Okay, so what's the easiest way to pump earnings per share?
Use leverage.
Yeah. Use leverage to buy back stock, use leverage to make deals, whatever it is.
If to have the patience to maintain a clean balance sheet and wait for the right opportunity, that's really rare. And it means that the management, and probably the board as well, is thinking long-term about the business and wants to ensure that the business survives in the long term rather than juicing up earnings in the short term to hit bonus targets, for example. And so that's another angle that I think is a bit underappreciated by investors generally.
So this is a very good rundown. And notice that Ernest didn't talk about share price in terms of performance. whether we use that as a buy or sell decision. No question, we would love to always sell and trim at the top and buy at the bottom, and have the foresight to know that a stock that we're buying maybe won't do anything for a few years. But, it's not like we're not paying attention to the share price, but we're looking at the businesses, the fundamentals of the business. And I always say if the fundamentals are improving, or it looks like it's running through a temporary issue that maybe the entire industry is going through, there's no reason to take any action. And we're always going to have stocks that do nothing for a long period of time. If you add that to another area of mistake that I've had is impatience over share price performance without recognizing that nothing has changed with the business, or maybe it's even gotten better, but I'm too stupid to recognize that because I'm driven by the price. So when clients, say that one hasn't done anything in a long time, or can't you see it's not, that business is going to be in trouble for the next few months. We know that, but if nothing has changed with the thesis, we're probably going to be buying more.
And especially because if you have a business that's growing, that's making money, and that's investing intelligently, it's getting more valuable. I think that's what people don't understand, is that a company that makes money is more valuable tomorrow than it is today. And so...
And even more attractive if the share price has done nothing.
Exactly. Yeah. It's by definition, it's getting cheaper.
Yeah.
So you can definitely afford to wait, even if you're paying maybe a little bit higher price than you would like to in the near term.
There's no rules in this game about how the money is made in investing in stocks. You can hold something for 4 years and have it triple in the 5-year period. You can have it go up 8% a year. You can have it go down, and there's no share prices. It's an open auction market. It tells the share price performance in a short period of time generally tells you nothing.
And in my experience, buying companies purely based on a low share price or a cheap valuation metric, oftentimes things just get worse. That's probably what ends up happening because the company's not in a good position. Maybe the management has turned over or may not even be there anymore. And the problems compound themselves and the company just gets worse and worse. And that's not how long-term investing should work.
Beautiful. Anything else you want to cover there? Because I want to talk about why we buy individual stocks instead of the S&P 500 or the TSX index.
I think we did a pretty good job of covering the types of companies.
So Ernest, a client will call you up. Guys had a nice year in 2023, but I see that you underperformed the S&P 500 over this certain period of time. Last year, for no question, we underperformed the TSX. This year, we outperformed the TSX. We outperformed the S&P 500. I mean, you're always going to out or underperform a certain index in any one period of time, but no question, the S&P 500 has knocked it out of the park. And I think over the long term, probably close to a 10% compound rate of return owning the S&P 500. Why don't we just do that for our clients? Call it a day and focus on reading more books in the office and doing more financial planning and services instead of wasting our time trying to pick the best stocks?
I think it's a fair question, especially given how strong the S&P 500 has performed over history. I think there's a few reasons why we still like to pick stocks. Number one is that we want to understand what we own. If you're owning the S&P 500, by definition, you're buying everything. You're buying the good, you're buying the bad, you're buying the ugly.
Buying the overvalued names, you're buying the undervalued, whatever it is, the good, bad, the ugly. I like that.
We think that the 20 or 30 companies that we own are better businesses than what you're getting on average in the S&P 500. And I think that if you look at our performance over time, I think that's proven to have been true.
Well, our style is always evolving. And I would say that 15 years ago, we owned very few U.S. companies. We're mostly Canadian. So we're always trying to refine, and hopefully you and I will still be learning more. And just because we're doing this style today doesn't mean we're not going to refine and improve. But the benchmarks always change for us, right?
Yes.
The comparative to S&P 500 may be reasonable today, not so reasonable in the past and may not be reasonable in the future.
I think another point is that we are Canadians, and the S&P 500 is a U.S. large cap index.
Correct.
And I don't want to be constrained by what types of companies that we can buy. For example, like the S&P 500 does not own Ferrari, which is a company that we own, because Ferrari is not a U.S. company.
Yeah.
It's an Italian company.
Italian company trades on the U.S. stock exchange, but because of the way it's structured, will never be put in the S&P 500.
Another example is Canadian Natural Resources, right? It's obviously not in the S&P 500.
Nope.
So
Arguably one of the greatest companies the world has ever seen, or the way it's managed.
So these are the types of companies that we want to be able to own as well. And indexing just doesn't give you that.
No, as well as picking weights to different sectors. Certainly the TSX index, very narrow. We saw problems years in the past when Nortel becomes a gigantic part of the TSX. It feels great when it's running up, but when Nortel, I think, got up to 40% of the index, you see now in Denmark, I think Novo Nordisk, the maker of Ozempic, is it? Are they?
Yes.
They're now like almost the entire index. And of course, now in the U.S., it's a great place to be. All the big techs are a big component of the index. That may not always work. And so, as you said, the good, the bad, and the ugly, being able to pick and choose what we think are the best companies to own. And there have been periods, of course, we all have recency bias. But there was a good decade, 2000 to 2010, where the S&P 500 did nothing for 10 years. And so your clients would not be happy just owning S&P 500 for a decade.
And lastly, I think there is a psychological element to picking individual stocks as well. If you own the index, it's kind of a black box, right? Like you're owning something, but kind of not really anything at the same time.
Yeah.
You have no idea what you're really owning. And I think it's very easy for an investor to get swayed by narratives. Like there's a lot of commentators out there that say the S&P 500 is going to crash like 50% in the
all
next
the time.
year.
Every day you get those headlines and someone telling us we're doomed. We're always doomed. We're always doomed.
The US is in a downward spiral of debt, right?
Oh, totally.
And I think if you own individual companies rather than broad indices, it's just a little bit more conviction that you're owning something that's good, right? I have a lot of confidence that Costco is going to continue to be the best deal in retail, right? And that people are going to continue to want to shop there in the future.
Yeah.
I think it's psychologically easier to continue to own Costco knowing that, rather as opposed to owning the broad S&P 500, where it's a little bit more murky about the strategy and the conviction that you have.
Absolutely.
With your investment.
And it's not reasonable I don't think very many investors have all their money in the S&P 500. They go to other advisors where they put a little bit in international, emerging markets. You got to have this. Oh, now you got to have alternative. So no one ever owns that. So it's never a fair comparison. Let alone no one ever holds the S&P 500 through thick and thin and always puts money into work every year. Maybe there's one or two people. But, having the flexibility to buy individual stocks means that if we find better opportunities in international, we can do that, as you mentioned. And so I like this style. I hope our clients and prospective clients gravitate to that. It makes sense for us and our temperament. Bottom line is you and I have to come to work every day as well as the other portfolio managers, and we enjoy this type of challenging work. And that's what we strive to achieve for our clients, is challenging work that hopefully leads to great results. So that's all we got for you today. We'll see you back here real soon. Take care.